We have a very special guest with us this afternoon, Eric Anderson, Lead Portfolio Manager, Milltrust Global Emerging Markets. Remember, their portfolio with regards to emerging markets is one that delivers extremely high returns. Eric, fantastic to have you with us. And you know, it's really all about this post-election fervor that's gripping the markets, at least here in India. What's your outlook overall for India within the global emerging markets portfolio currently?
Well, yeah, no, thanks for having me. And we actually moved up our exposure to neutral. We have been underweight for a number of reasons. I mean, typically the way we look at Indian markets, we have a short-term view. So we look at 6 to 9 months, I guess more or medium term. And we look at a number of factors when evaluating the countries. So from India's perspective, you know, what's worked well, the positives is that you have improving sentiments following the Modi victory, which will translate to positive equity markets. Accommodative monetary policy, you have a growth rate trending above policy rate, above the inflation rate, and a positive terms of trade. So all of those are generally positive for equity markets. That's the good side of the equation. The more challenging one, and the reason we're still neutral, is the valuations, and we're a little bit high from both absolute and a relative basis. So if you look at the one-year forward valuations, they're trading 50% over the EM average and 20% over the long-term India average. Return on equities dipped a bit below the EM average, and dividend yield is a bit low. So there are still some better opportunities elsewhere in EM. So whilst we have an improving outlook, we're still neutral. I think where we look to go overweight is when we see improvement on the valuations. And I think that will come from earnings growth. I mean, it's been relatively poor the last 5-7 years. So we certainly expect, as capacity utilization improves, that will sort of unlock some earnings from our viewpoint.
So, Eric, hi, afternoon. Aisha as well joining in. So, what is your view then translating to? Because like you rightly mentioned, it's a decisive political mandate in the backdrop of valuations which are high and earnings recovery which is long awaited. Do you think now that the big event risk, that's the election mandate, is behind us, we are going to see an inflow of foreign investor money actually kicking into India? Because globally, like you said, within emerging markets, India is one of the most favored ones. Or do you think that top of investors' mind is valuation and earnings, which is why you're not really going to see a gush of money flow through?
Well, yeah, I mean, foreign investors buy India for 3 reasons, right? Favorable demographics, rapid growth, and a pro-business government. That's not going to change. The big one is probably the demographic driver. It's a very powerful story. So, I mean, as you pointed out, we're still seeing a lot of foreign portfolio money on the sidelines. They've been waiting and watching to see what happens during the election. This is now over. You're likely to get a lot of short-term money come in off the wave of euphoria following the election. But still, in our view, medium to long-term flows are going to wait and see what Modi does next. And we can't forget, one of the big things that came out was how Modi's structural reform agenda gave way to populist policies this year. We also saw the RBI under government pressure deliver rate cuts. So this supports equities, certainly in the short term, but isn't necessarily great for structural reform agenda and the long-term sustainability of growth. So, but now the elections is over, we could see, a reduction of the populist policies because he has a big mandate now. But this, again, could fade economic momentum. So, it's a mixed bag. But having said all of that, India is growing 7% as a huge demographic driver, and you don't find that anywhere else in emerging markets. So I don't see anyone cutting exposure. I see people maybe waiting and seeing on the sidelines.
Right. Can you just talk about, when we talk about the emerging markets as well, flows into emerging markets have not been that great, but in the last 3-4 months, you've seen evidence of, flows returning back to EM. Do you expect this risk on trade for emerging markets to continue?
Well, I think, yeah, May has been record breaking in terms of outflows. I think the EM ETF has been hit significantly hard. We think going forward, the global liquidity backdrop remains supportive. We call it the Powell put, the Fed's Powell put. Also, the ECB is very dovish language as well. So we think there's room for comfort here. In such a context, we don't see any risk of sustained hot money outflow from EM capital markets, or even the risk of contagion from economies like Argentina and Turkey we've seen in the past. So we think going forward, we are optimistic. This, of course, assumes there's no political miscues, escalating trade war, etc. So that's how we see it.
Coming back to that trade war in a moment, Eric, but we noticed that you're also overweight China in your portfolio. How does India compare to China? It's a favorite question there. But how would you compare the two behemoths right now?
Yeah, no, it's a good question, and I think I always kind of think about it from looking at the big picture. China attracts a lot of praises for its top-down management. It's a command economy, it can do a lot of things. Typically, you don't buy India for its government. You buy it for its corporate governance. I always like to refer to that. India is run by a federal structure. It's got 29 states. They play a dominant role. I think it's about 2/3 of the total government spending is sort of funded and controlled at the state level. But if you look at the stock level, let's focus on the stocks. If you screen both stocks' main universes for companies, let's use an example here, over 100 million market cap, 10% return on capital employed, average earnings per share greater than 10%, if you do it over 5 years, you're going to see twice as many companies in India than China that qualify under that criteria. So from a stock picker's perspective, it is very, very exciting and interesting. But we know, I always say this in my meetings, there are two ways to make money in EM. One is picking the right stock, and the other one is picking the right country. So at the moment, China is more still an overweight for us. We're seeing more opportunities there from a top-down perspective. But India is certainly coming up. So that's the kind of the nuances between the two countries.
Okay. So let's try and understand, the big giant in the room or the elephant in the room, this entire fear of a trade war between US and China. And I want you to understand, or rather help us understand, what could be the impact on India, because many believe that it is going to be advantage India in a situation where manufacturing has to move out of China. But we all know it's easier said than done.
Yeah, I mean, it's, bilateral tariffs, this is the rule of thumb. They alter global competitiveness to the advantage of firms operating in countries that are not affected by them. This will happen. And this is reflected in import and export patterns around the globe. As you mentioned, this is going to happen. And interestingly, there was a report a few months ago by the UN that kind of highlighted this and see which countries would benefit. In fact, India was in that group. They have their competitive economy, competitive corporate sector. They have the economic capacity to replace U.S. and Chinese firms. So just from a supply and capability perspective, India is well placed. So in the report, I think it said $11 billion increase to the exports, 3.5% of existing exports will improve if the trade war deteriorates. So certainly there is a place there. I can see, India doing well in the garments, gems, jewelry sectors, which you're already competitive at. And also, we have to remember, India is also, I think, give or take 70%, a domestic consumption economy. So the reliance on export is low. If I take my global EM hat on, right? So if I look at China, big reliance on manufactured goods, Indonesia, big exporter of coal, Russia, oil and gas, Brazil, metals and other commodities, South Africa, precious metals, et cetera, exporters of precious metals. All of these other large EM economies will suffer more than India, just because they're more exposed. Also, India has the great thing of being a net importer of oil. So if there is a global slowdown, they will benefit. So, you could say as an equity investor, maybe India is a safe haven. Maybe, if you look at the Nifty and the stock market, a lot of it derives a lot of its revenue from domestic consumption. So it provides a very intriguing play in the case of a deteriorating trade war. So we could potentially see it outperform.
Eric, the World Cup kickstarts today in London. How is it that you're discussing markets and you're not at Lord's already?
Well, it's I've been in emerging markets for almost 15 years now. So I live and breathe, and it's a 24-hour market from London. Asia in the morning, Latin America in the afternoon. So But India remains and Asia remains the bulk of our exposure. So I'm always up early.
That, you know, well, you know, that's how people in financial markets live. They want to be 24/7 all around, you know, looking
in front of the screen.
in front of the screen, looking at various currencies, various markets, wherever there is any opportunity.
Yeah.
Eric, thank you so much. Pleasure chatting with you today. And, you know, I'm sure we'll be speaking with you a lot more frequently here on ET Now. Great chatting with you. Thank you.
Likewise. Thank you very much.